Welcome to Trading Nation. I'm Brian Sullivan. Joining us by phone is Tom McClellan, editor of the McClellan Market Report. They do a lot of great, excellent technical analysis. And Tom joins us now. Tom, thanks for joining us. I mean, the interview came about because I had posted something on my Twitter feed and on the show basically saying that, you know, we had a 6-year bull market in the Dow or in stocks. We took it 18 months off for the campaign, effectively, and then the market rally began again. And you wrote back and said, well, not really. There may be two separate bull markets here that may not have much to do with each other. Please explain.
Well, it's easy to go back to 2009 and say, well, that was the end of a bear market because that was a pretty awful bear market, and therefore it was the start of a new bull market. But if you understand what the Fed was doing for the last 6 years with its 3 different rounds of QE, you can see that each of the big surges that we've had higher since that 2009 low came on the back of QE, pumping money into the banking system and having it flow through and trickle down into the stock market. I know everybody hates that word, but after QE3 ended in 2014, that's what started the big flat that we saw in 2015 and 16. What's interesting now is that the post-election rally is happening without any QE from the U.S. Federal Reserve. You can argue that, well, the Bank of Japan and the European Central Bank are still printing money like crazy, and money's fungible, so it's flowing in from there. That may be true, and I don't dispute that. But we're seeing an uptrend that is not attributable to the Fed, and that's kind of the difference now.
So that gap of 15 to 18 months that just happened to fall during the election, was any of that related politically? People saying, we don't know what's going on, this is getting heated, let's just sit back and watch?
Oh, sure, yeah. Election years are much more iffy throughout history because especially when you have the end of a second-term presidency, you're guaranteed you're going to get somebody new. And even if either of the candidates would be fine in everyone's minds, just not knowing makes you feel uneasy, and investors hate an unknown risk, and so they don't move. They're frozen like a deer in the headlights. Then once they know, they can feel the relief, and they can let their money get back to work. And so that's part of what we saw after the election was just the fact that we knew the answer provided a whole lot of relief. Some people say, well, that it was the exact nature of the answer that we got, that Trump's victory, that was what caused the rally. I think that a big chunk of it, as you implied, was just from getting past the not knowing phase.
So given what you've just told us, and let's bring that initial chart back up if we can, guys. How much longer do you think this new, I guess, or second phase of the bull market has to go?
It's got several more months, although I'm expecting a big dip in the month of October just to scare everyone off the track. Everybody's gotten into this whole passive investing forever, and I'm just going to keep my money working all the time. I'm never going to take it out. And once that sentiment gets too firmly entrenched, then the market has to make them think again. And it typically does that by having a nice sharp dip to get everybody fearful again to fuel the bull market. But one of our leading indicators is based on some data from the Commitment of Traders report, and I sent you a chart about that. It looks at euro-dollar futures. Now, that's not the currency. That's interest rates. It's a dollar-denominated time deposit in a European bank. And when you look at the commercial's net position, you see that the stock market tends to follow that with a lag time of about a year. And that peaked earlier this year in 2017. So that says that in about the springtime of 2018, we should see the echo of that as a peak in stock prices.
Yeah,
but
you know, it's fascinating. It's fascinating you mentioned passive because bizarrely, my wife and I were talking this morning, literally, because that's how boring we are. And she was asking about the market and what I was concerned about. I said, actually, I think that an ETF-driven macro decline is the biggest fear that I've got for the stock market because we've never been here. We've never had this level of passive investing. Everybody owns this stuff thinking they're just going to whatever, and that there's so few companies that control the weight of these ETFs. What kind of a fear level should we have from this sort of, you know, quote, super safe ETF and passive environment?
Well, even bigger than just the regular ordinary type of ETFs is the short VIX ones, which a blow up there could really really torpedo a bunch of portfolios. If you think back to the 2015 time frame in August, remember the little China-fueled mini crash that we had?
Yeah.
We saw the VIX go from 13 to 40 in 5 days. And so a move like that now from 9 to however high, you could torpedo and completely wipe out all the value in XIV and some of the other short VIX ETFs. And that people are not factoring that risk possibility into their thinking.
Yeah, the ETF, we've never been here before, and anytime that's the case, I get a little bit nervous. Hopefully I'll be wrong. Tom McClellan, really interesting stuff as always. Thank you for joining us on Trading Nation.
Thanks, Brian.
Folks, check out the live version on CNBC's Power Lunch. I'll see you there as well. Take care.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.